So this is going to be basically in two parts. Right now, I'm going to start talking about where we are in the market, how we got to where we are, and then I think where we're going in the future. After that, Chelsea's going to take over and she's going to talk about all of the programs that are available. And these programs that are available are unlike anything I've ever seen. And I feel like as we try to share this information, we're trying to shout it from the mountaintops that there is really accessible money for you to get with not a lot of strings attached that can really make a significant impact on purchasing a home. So I'm going to start with where we are, what's going on with the market, how we get to how expensive pricing is here in Truckee, and then Chelsea will take over and talk about how we can get you guys access to these funds. So to the housing market update, why does it cost so much in our region? How do we decide on prices? What are comparables, the supply and demand, and regional trends, workforce housing, and what happened with the pandemic and how that screwed everything up. So question that I get is, why is it so expensive to build up in our region, right? So it's what I call the perfect storm of building codes. And what we have up here, so we're in California, right? And everybody knows about the forest fires, right? That's been top of mind for several years now. Fortunately, we had a great season this year where we didn't have any smoke days, knock on wood. Hopefully that's behind us. But historically, fire season now goes to the end of October. But anyhow, so we have wildland urban interface, okay? So that is us. We are the urban areas that are interfacing right with the wildland. Okay, we are up in the forest. So with that, there are a lot of mitigation measures that we need to put into our houses when we build them, and those are very expensive. Then on top of that, after last winter, we all know how crazy the snow is. So we've got these crazy snow loads. We have to build these extremely strong buildings. Then on top of that, we're in California, and even though we're pretty much out of like a real danger zone, I'd like to think, for the earthquakes, California has extremely strict rules on how we build buildings to make sure they can withstand a magnitude 9 earthquake. So it's extremely expensive to build from that regard. Then on top of that, we go to Title 24. Most people don't know what Title 24 is. California Title 24 is basically energy regulation mandates. And every couple of years, they make it more and more stringent. For example, recently, we've decided that we have to basically have solar panels on all of our houses, even though they don't look solar panels that can handle the snow loads, but still we have to put them on. It doesn't make any sense, but it just costs more money. California has done a great job leading the way in energy standards. And we have essentially some of the most efficient homes in the world now. And then the rest of the country follows us with some of these Title 24 standards. So for example, all of the appliances that we have essentially in the market now are all this high standard of efficiency, and that's because of California. So it's great things for the environment. We're leading the charge, but it costs a lot of money. And then on top of that, we have impact and permit fees. So anytime that we go to build a house, we have to pay for a permit, but then we also have to pay for impact fees. And those impact fees are things like fire department, schools, parks, sanitation, sewer, things like that. So these are all the things that go into building a home, and then that affects the costs of other homes on the market. So right here, here's a picture of, this is a house here in Truckee. This is your quintessential California ranch style home. There's millions of these homes all over California. It's essentially a single level, 3-bedroom, 2-bath, about a 1,500 square foot home with an attached 2-car garage. So this home right here was built in 1980, and we cannot build this home anymore. We can build a home that looks just like it, but we can't build this home. People often ask, why don't builders just build homes that are affordable? It doesn't, how come we don't just go into, this is in Sierra Meadows. Years ago, this home was, in 1980, this thing was probably built for about $125,000, right? I'd like to share with you some numbers of where we're at in building costs. And in order to build this home now, essentially, we'd be looking at about $150,000 for the land, about $58,000 for the permit and impact fees that I talked about. So that's the building permit, that's the schools, that's the fire department, that's the sewer, that's, all the other stuff that, everybody's got their hand out. Then on top of that, you got to pay somebody to design it, right? An architect, an engineer, residential designer, something like that. And $20,000 number in there is very modest. Like, this is like a low number for that type of professional fee service. And then, like I said, California Title 24, I just want to throw that in there, $15,000, right? Whether or not there's enough sun, whether or not it's going to work for 6 months out of the year, because because it's got snow on it. Whether or not you have to replace them every year because the snow breaks them, we're told that that's what we have to do, right? So you're $243,000 into a deal like this before you put a shovel in the ground, all right? So it's literally impossible for somebody to come in and build something like this and sell it for $450,000 or something that would be accessible to the local workforce, right? So 243 grand before we break ground, and then about $600,000 for construction costs, because those, like I said, we've got all those things that go into it. And every year, by the way, every few years, by the way, they upgrade the building codes and they make things a little bit more difficult. We have to add a little bit more material. We have to make it a little bit stronger. We have to make it a little bit more fire safe. Like all of our homes have to have fire sprinklers now. It's a great thing. Fire life safety saves lives 100%. There's no question about it. But just like all of these layers just constantly make it so that it costs more and more and more and more money to build these houses. So then you've got a guy that wants to make some money, right? So you got 600 grand into the cost of building the house. And this is just a basic California rancher, 1,500 square feet. You've got $243,000 before you stick a shovel in the ground. That guy is going to take some risk on it. He wants to make some money. There's some fees included to close the deal and all that. So we're into a little house like this at the end of the day over $1 million, right? It's insane. So for those of you new to some of the language that goes into buying a house, we value homes by comparable properties, right? We call them comps. So you may hear that thrown around, but that's how you come up with the value of a home. So we go back to a house like this. So a house like this built in 1980 can still trade for less than the $1 million it would cost to replace, right? But let's say this house sells for $750,000. Well, that's now a comparable price. So if this house sells for $750,000, which is a reasonable amount of money in this market, then that affects what the value of the houses are in the neighborhood, right? So if you have a similar house, then that similar house, for all intents and purposes, is valued at that same $750,000. So as the cost of new construction goes up, it drives up the value of the comps. Now, a brand new house, if we put that house that we just looked at and a brand new version of that same house side by side, the brand new one would obviously sell for more money because it's brand new, but it would drive up the cost of that comp. Let's say if that brand new one sold for $1.1 million, well, then that resale house is now worth probably a range of $900,000 to $950,000, right? You get a little bit of a discount for it being older, but as these costs continue to rise, historically, the costs of the houses go up. So that's one thing that I wanted to share about what goes into building these houses and then how we're getting to these high levels in Truckee. All right, so housing demand, okay? So housing demand has gone up over the last 52 years. We have doubled our population in the United States. So that's twice the population, but we haven't built twice the houses. That's the problem with demand. We talk about the housing, this is a housing crisis. It's absolutely a crisis right now. We just have not been able to keep up. And some of the things that have gone into that is housing population's doubled in the last 50 years. We haven't built enough houses. We were building a lot of houses and giving a lot of crazy money away in the early 2000s, which led up to the economic crisis of 2008. So the economic crisis of 2008, we had so many bad loans out there and so much money available out there and so many builders building all this inventory. And what happened is people couldn't keep up with their payments, and we all basically know what happened. Like the economy collapsed and production stopped and the housing market absolutely crashed. And this is when housing prices basically were cut in half. So the value of homes went from where they were to half of that. And it got to a point where the builders couldn't build the houses for the value that they were worth, right? Because of the fact that the market crashed. And after that, we've had 14 years of less than needed replacement inventory coming online while the population has still continued to grow. So the demand out there for houses is still just, it's insane. And we haven't been able to keep up with that and build fast enough. So now let's talk about what's going on regionally. All right. You guys have probably all seen this. Base Camp for a Big Life, Truckee Chamber of Commerce. Whether or not you like it or regardless of how you feel about it, they have done a really good job of getting the message out. Everybody knows about Truckee. It's been in Sunset Magazine. It's been in all the top 10 ski towns, all the stuff, right? Everybody knows. The secret's out. Genie is out of the bottle. We're not putting that toothpaste back in the tube. And you guys have all experienced it, right? The pressure we've seen on the roads when we get the gridlock for Palisades, the weekends where all the Airbnbs are packed and the stores are packed and you can't get into a restaurant, or those of you that are working in restaurants are just getting crushed. So everybody knows, right? Well, what's happening elsewhere in California, all these people know about Truckee. They've been coming up here. They love it. It's amazing. And in the meantime, the rest of the state is going to pot. Okay. These are just a couple things that I found on Google real quick yesterday. There was 80 people ransacked Nordstrom's in Walnut Creek, and then the crime continues to dominate California's Bay Area. So this was July 31st, 2023. You can go find article after article after article about the mayhem and the chaos and just the total just lawlessness that is happening down the hill. It's tragic. And then in the meantime, we have a major problem throughout the state, throughout the nation, of mental illness and dependency masquerading around as homelessness, right? There is a housing crisis that is part of the reason why we have this situation, but it's rampant and it's everywhere. So this is current state. This is in Sacramento right now. You've got tent cities. We've got Walnut Creek. You've got tent cities under the highway. We've got Oakland. It is just absolutely insane and disgusting. It's heartbreaking. And there's nothing that we can do about it right now. Marin County, miles of RVs just dilapidated, broken down, literally leaking sewage into the waterways. I mean, this is what's happening in the rest of California. And in the meantime, Base Camp for a Big Life messages got out there. So these people that are coming up to go recreate and hang out are wanting to get away from this. And they're coming up here and they're telling me this, right? I meet with them. I sell them homes. And in the drugs, it's on the street. It's awful. We don't have that mostly because it's hard to live here, right? You got to be tough to live in Truckee. You got to understand living in snow is tough. It's not San Francisco where it's nice and warm all the time and it's great to just sit on the sidewalk and shoot up heroin, right? So, I mean, I hate to be so blunt about it, but more and more people are coming here. And the reason why I'm sharing this information is because there's a lot of people out there that are thinking like, I'm going to wait to buy when the market crashes. There may be a market crash in certain parts of the United States. There may be a huge correction in certain parts of the United States. I don't believe that there will be a correction in the market where houses are going to get cut in half in price again. I don't think so. You know, we saw a huge ramp up in the pandemic and then it started to level out. And then we have some interest rates, which Chelsea will talk about more. And the interest rates are up. They are up. They're really high compared to what they were when we had crazy low interest rates from the pandemic. But on a 30-year average, they're not that high. So I firmly believe that right now is a great time, if you can take advantage of these programs that we're going to talk about, to get into the market. And the reason why I say that is because right now, prices are leveling off. Sellers are willing to negotiate. There's ways to get into deals where you can lower your interest rate by doing a rate buy down that Chelsea will share with you. And there's not a lot of competition right now. Now, these high rates won't last forever. When they do come down, and it'll probably be within the next 12 to 24 months, the demand is going to go back up because of all the reasons that I just talked about. People want to get here. They want the clean air. They want the clean water. They want to get away from the mayhem. We haven't built enough houses in the past 15 years to keep up with growth. And when those rates go back down, the competition is going to go back up. So right now, you guys can get into a situation where you can make it happen and get Chelsea locked in with the pricing. You can get into a deal. Whereas if the rates go back down to 4%, it's going to be back to the multiple offer game, and there's going to be 20 people for every house that's available. So I know that sounds doom and gloom, but I just wanted to share that with you. Like, this is why the market's not going to crash in Truckee. People are going to come here. The housing values are going to go up. If you get into a house now, you will make equity because the value of your house will go up over time. So what does it take to buy a house? Everybody got an email today. I sent you my buyer's guide that has a lot of information in it. And I'm just going to briefly talk about the 10 basic steps to getting into homeownership. If you're interested, the next step after this seminar is going to get pre-qualified with Chelsea and then connect with me or another agent that you want to work with. I'd love to help you. If you have somebody else in your life that you want to work with, totally fine with that. Just here to try and get this information out and help people. Step number one, buying a house, find the right agent. Find somebody that's competent. Find somebody that you trust. Find somebody that you want to work with. Buying a house is hard. Buying a house is stressful. Buying a house is going to be potentially one of the most intense transactions of your life. You want to make sure that you're working with somebody that you are willing to have a relationship with and you can trust them to help you through this process. Next step is preparing finances, bank statements, tax returns, have all that stuff. Underwriting, the underwriting process, which is the process of the bank basically examining your whole financial life, is a total headache. It's a big nightmare. I'm not going to lie. I'm not going to sugarcoat the process and try and make it seem like it's, super easy. I mean, home ownership is attainable. It's hard. There's hard work that goes into it. You got to have all your stuff ready to go. You got to be organized. Step 3, get pre-approved. Talk to Chelsea. Make sure that you understand with these programs or without how much home you can afford. Okay. There's no point in looking at anything until you understand what your monthly payment's going to be, what that payment, including any homeowners association dues, your insurance, the taxes that come with it. You got to understand that whole big picture and come up with the price that you're able to look at properties. Then you can start home shopping. At that point, once you've found a place, then you make an offer. There's some negotiation back and forth typically. Then ideally get into contract. And then we look at our inspections and disclosures. We take a look at what the property, all the information that we know about the property, all the information that the seller has to share with us about the property, and then any investigations that we want to do about the property, find out everything that we can know. At this point, you can get out of the contract, right? Just because you write an offer on a home doesn't mean you need to buy that house. Like writing an offer doesn't mean like you're committed. So you can make an offer and say, okay, Mr. Seller or Mrs. Seller, we're willing to pay this much for your house. And they agree to that. And it's subject to understanding these other conditions of the quality of the home. We do inspections. Is the roof in good shape? Is the foundation in good shape? Does it have termites? Is the plumbing leaking? Blah, 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 blah. Figure all that stuff out in that period of time. If you want to get out of the contract because it needs a new roof or there's termites or whatever, right? You can get out, you can get your deposit back. It's no harm, no foul. Then you've got next step is loan and appraisal removal. So the bank wants to do an appraisal to understand the product that they're loaning their money on because they're the one that putting most of the skin in the game until you've got to come with some skin in the game, but they're putting most of the money down. They want to make sure that the house is the value that we're writing the contract at. And again, that's another thing that you can get out of the contract for. So if we've written a contract, we're in contract, we've done all our inspections, the roof's good, the foundation's good, everything's good, the appraisal comes back, we've said this, we've written this offer on this house for X amount of dollars, and the bank comes back and says, whoa, we think it's worth 10% less than that. Then we could say, hey, seller, I'm sorry, I'm out. I can't do it. So again, you can get out of the deal with no risk. Next step, once we've got all of that figured out, we know that the loan's good, the appraisal's good, the roof's good, the foundation's good. Then we say, okay, seller, we're all in. We're going to close this deal. Then after that, the bank comes up with paperwork and gives us what we call clear to close. And that's when they say, okay, you're good to buy this house. We're going to have the paperwork over to the escrow officer and we can close on the date that is in the contract. After that, then it's just closing. So I know I kind of glossed over that pretty quickly, but if you take a look at the buyer's guide that I sent you earlier today, it goes into greater detail on all of those steps. And if you have any questions about that, just reach out to me at any time and I'm happy to share it with you. So that's what I've got for where we are, what the market looks like, what it looks like to buy a house. I firmly believe that even though the pricing is high here in Truckee now, I think it's going to go higher over the next 10 to 20 years, right? Like look at what house prices were when you were a kid. I look back a house that I bought, 25 years ago, something like that. I bought it for about $315,000 and it's worth $1.4 million right now. And I wish I kept it. So prices are just going to keep going up. Chelsea's about to talk to you about amazing opportunities and I hope that you can take advantage of them and get into the game. All right, Chelsea.
Thanks, Dave.
I'm going to stop sharing.
I thought that was amazing about all the costs for the construction. I had never really heard a breakdown like that. So
yeah, I'm happy to share it. And that's why I wanted to talk about my background in this industry. And that's the viewpoint that I come from. And we didn't even talk about some of the stuff about the pandemic. For example, we used to get most of our steel from China. So China shut down. They did a zero COVID policy where they shut everything down for almost 2 years or something like that. So all of these supplies that down to things that you wouldn't think of, right? Like normally as a builder, when I start talking about steel, I'm thinking about like the steel beams, right? But nails, staples, the steel that goes into making a hammer, all of these things like have gone into it and just driven these costs up and up and up. I think it's important to know what goes into building a home to understanding why it costs so much. And because of that, like I say, I don't see these costs coming down anytime soon. I don't see, short of a major situation with the economy, these housing prices going down. And if there's a major situation with the economy, then chances are nobody's gonna be able to buy a house anyway. So anyways, take it away. So now that I've crushed everybody's spirits,
I'll bring some good news. Although I feel the same way. I know it's very unaffordable to buy a house right now. It just is for everybody, not just locals, but for everybody across the nation. So we had talked about interest rates. This is a website that we like to use. It's called Mortgage News Daily. If you are interested in really diving in and knowing a lot about what's going on, I recommend this website. They have accurate data to what's going on with the interest rates. So you can see on average, this is what they call a top tier scenario, which is 25% down on a primary residence across the nation and with perfect credit. So 7.44% is where rates are. Obviously, they were quite a bit lower 2 to 3 years ago. We were more like 2 to 3% range. And the general consensus is that we're not going to see those interest rates anymore, but that we will land probably around 5%. And that's very standard and very average. I don't know the age of who's on the call, but I'm 36. So I was just coming out of high school when the 2008 crash happened. And so I don't know adulthood without 3% interest rates. And so it's become quite normalized to at least millennials that that's what we thought that rates should be. But historically, rates have never been that low. So they will come down from where they are. How long, we don't know, but I'll talk a little bit more about how we can protect against that. But that kind of gives you an idea of where we're at right now. As we are looking in our local market and what is the biggest hurdles for us, it's we don't have a great way to make a lot of money in our industry. We're generally, seasonal work or heavily reliant on certain industries. And so it's hard when our area median income is not that high and these home prices are generally around $1 million. Coming up with down payment, especially when rents are skyrocketing and you're having to pay so much just to make ends meet, how do you set aside money for down payment? It sometimes can seem impossible to do. So there's good news on that front as well with these awesome down payment programs that have come out for locals. And then, like Dave talked about, there's a lot of competition out there. People who are trying to buy into the area and they want to raise their families here, and I can't blame them because it's an awesome place to be. But how do we compete? How do we make this happen? So I'm going to talk to all of these points here. And as Dave had mentioned, the number one thing that you're going to want to do, no matter how far away you think you are from purchasing, you want to get pre-approved or apply, okay? Because maybe you're a little bit a ways away from making it work, but it can take 2 to 3 years, 4 years to be ready. And if you don't know what steps you're supposed to be taking or where your weak spots are, you're not going to take the right steps and you'll set yourself behind even further. So when I was wanting to purchase my house, I knew what my budget was. I knew I had bad credit that I had done to myself when I was a young single mom, and my bills just had become too unaffordable during that recession. And I knew I had work to do for that. And so I started my credit repair 3 years before I was able to buy, even though I had the down payment. I had the down payment, I had the income, but I didn't have the credit score. And so if I had not done that pre-work to get a pre-approved and figure out what I needed to do, that process would have taken me quite a bit longer. And so speaking to a lender right away is going to be the best thing to do. If you don't qualify right now, nothing happens. There's no cost. Us for sure at Guild, we can do a soft credit pull so it doesn't do any kind of hard inquiry on your credit. That's usually, I think, the fear for a lot of people who are applying for the first time is A, my credit's not really where I want it to be, or is it going to hurt my credit to apply? Both of those are not true. We actually can take a look if you have credit challenges. We actually can help to at least look at what could you do to improve it, or if it's significantly damaged, we can refer you out to a credit repair specialist. And you don't have to be in the perfect position to buy. There's not somebody that's sitting there saying, you absolutely are, now that you've applied and it doesn't work out right now, you can no longer buy a house. No, it's either, yes, you are pre-approved for this amount, or here's the steps we're going to take to get you there eventually. So sometimes we're working with clients for many years. The employment is another thing. If you are self-employed, we definitely want to get eyes on tax returns, because as you're going through the process of filing your taxes, it's expected that you're going to write off as much as you possibly can to limit what you're paying in your taxes. But it needs to have an opposite relationship when you're applying for a loan. If you want to buy a house, you're going to have to bite the bullet and pay some more in taxes to show that your income is higher. Again, if we can look at the taxes and we can look at your overall debt structure, we can say, okay, here's where we need it to be for you to qualify for what you want, and set the goal there. What does next year's taxes look like? I just did this with someone that was perfect. He's on extension for 2022. He's trying to do a cash out refinance because he hasn't filed that yet and he's filing in 2 weeks. I'm able to look at his taxes and say, okay, I need you to have this bottom line amount to get done what you need to get done. If he had already filed those, we would have to wait another year. So it's really good to get these things looked at. Also for employment history, if you're you're not self-employed, what they're looking at is stability of income and that you're trending to at least stay where you're at. You're not having large gaps in between employment. You're not hopping from one industry to the next. We want the underwriting process is wanting to see that you are expected to make at least what you're making right now, that you have a 2-year history of some stability in your industry. And then savings and down payment assistance. Aside from local down payment assistance programs, actually, I'll go back to credit scores a little bit. You don't have to have perfect credit to buy a house. By the time I bought my first house, I think my credit score was probably 660 maybe. So you can see it was quite a bit lower when I started even the credit repair. So if you're doing, depending on what type of loan you're doing, you don't have to have perfect credit. That's totally fine. And knowing that interest rates are as high as they are right now, most likely you're going to be refinancing at some point in the near future. It's okay to buy now with bad credit and fix it. And when you refinance and your scores improve, you'll see a better interest rate. And that can happen sooner than you would think. So not to be deterred if there's credit challenges there. For the down payment and the savings portion of that, there are programs outside of what's the local programs, which are amazing. If you can qualify, I highly suggest you use them. But there are some FHA programs that have 0 down payment required. You can do 3% down, 5% down. It doesn't have to be a massive lift. Although the more money that you have put towards the down payment, the better off you're going to be payment-wise, interest rate, mortgage insurance. So there's benefits to having more down, but a lot of different ways we can structure if this is the challenge. I'm going to go over a lot. There's a lot to know about different programs. So I'm going to be doing a general overview of a lot of these things. I'm happy to talk to anybody anytime if you have questions. Even if you're not ready to take the leap and put in the full application and just want to talk, that's fine, because what is the answer for one may not be the answer for another. There is an art and a science doing loans, and it is not a one-size-fits-all, highly dependent on your individual situation. The down payment assistance programs that we're going to cover here, there's 3 big ones that are local to us. The longest running is the Martis Fund, and the Martis Fund is a loan. It comes in the format of a loan, and they will give you up to $75,000 towards the purchase of your home. These guidelines change often. Several years ago, they used to give $50,000. For a while, they were giving $100,000. Right now, the amount is $75,000. So that's always subject to change. They do, from time to time, run out of funds and need to wait for it to be replenished. So we're always going to look at what does it look like if we have Martis Fund or if we don't have it for you. But the interest rate on the Martis Fund is 3%, which is amazing considering that we're at 7.5% on conventional loans right now. So being able to borrow $75,000 at 3% is massive savings for you rather than taking it in the first loan. You're not required to make payments on the Martis Fund loan. We do recommend that you make a monthly payment towards it, around like $200, just to ensure that you stay ahead of the interest, but it's not required. It's due and payable either when you sell or after 30 years if you choose that option. There's a couple different repayment options for Martis Fund. They have a great program administrator who runs through all of the options, does a meeting with you so you understand what you're looking at for repayment. And just a few of the general guidelines. What does it take to qualify for this program? You can't have owned a house or been on title of a house for the last year, last 12 months. 51% of the household income has to come from employment within the Tahoe-Truckee Unified School District boundaries. So somebody in the family, somebody in the household has to be, and who's making the breadwinner has to be working within the school district boundaries. The income limit is 180% of the area median income. And this is what is so awesome about these local programs is that they do recognize that even though as locals we don't make that much money, it's still higher than the average, especially like in Nevada County. We're also lumped down with down the hill, in the Auburn area where there are lower prices. So being able to go above 100% of the area median income is not that common in down payment assistance programs. Usually they gear it towards the low lowest bracket of income earners. So this makes it to where a lot of people actually can afford this and or fit into the qualifications. So it's 180% of the area median income for this. They use household income, so anyone that's 18 and over living in the house is what they're using. That's a general overview of Martis Fund. The key points to remember is that it's a loan, $75,000, and 51% of the area median income. Also, one other thing I should mention as well is that you have to buy within the school district boundaries. That's where the house needs to be located. And they also do require you to have 3% of your own money, of the 3% of the purchase price to contribute. So you have a little bit of skin in the game as well. It can be gift funds, it can be retirement funds, but they do ask that you bring that in. The next two programs are similar to each other. Difference is some of the qualifying guidelines and the areas that they serve. So Truckee Home Access Program is through the town of Truckee. These are newer programs and they worked really hard to bring these to us, and I think they're amazing and they can really help boost your wealth if used properly. So when looking at Truckee Home Access Program, you are going to want to be focusing obviously within the town of Truckee limits. There's a portion of Truckee that falls in Placer County towards North Star that you would not be able to use this program for, but anywhere within the Nevada County, town of Truckee district limits is where you'd be looking at this. You have to have one household member who works or is self-employed full-time within the school district. So this is different than Martis Fund where they require the primary earner to be within the school district. As long as one person is working within the school district, you can use this one. You have to be able to get primary mortgage financing, which is a given for all of these. You have to go through pre-approval from an approved lender. Not all lenders will work with these programs, so our team is certified to work with these programs. You have to have these also as a primary residence. Some of them allow you to rent out, some do not. You also can't, for Truckee Home Access Program, you can't have too much assets in the bank. So they don't want to see that you have more than 30% of the home's purchase price in liquid assets after closing. Because if you do have a lot of money available, they want to make sure that they're actually using these funds for buyers who really, really need it rather than someone who wants to just keep their savings. What I love about this program that differs from the other two is that they don't require you to bring in any of your own money. So if you have zero in savings, you could just use THAP and you would be able to purchase. They're giving 16% of the down payment and closing costs towards the purchase. And they have a home price cap of $937,500. So the max assistance is $150,000. And the area median income for this program is very high, 245% of the area median income. So that gives you a significant pool of people to choose from as people who are looking to buy into this, or if you have locals that are looking to buy your house once you've closed on this, it opens up a lot of doors. Where this differs from Martis Fund is that it's not a loan, it is a grant. So the money that they give you doesn't need to be repaid. They are paying you in exchange for a deed restriction on your property. When you sell this, you are selling to another local that qualifies for the program. So that money is yours free and clear. You never have to repay it. But when you go to sell, you are naturally sort of limiting your pool of buyers, which is what deters people from these types of programs. Is it's a little scary to think, well, I want to be able to choose who I sell my house to. Well, if you're purchasing anywhere in the $600,000 to even up to the $900,000 range, there's a lot of locals that can qualify for those. There is a high demand for homes in $600,000 to $800,000 range. There are tons. We have 40 pre-approved buyers just waiting for these kinds of houses to come along. So just in my experience, there's no shortage of locals who would absolutely love to get into one of these houses, even with a deed restriction on it. And then the Placer Workforce Housing Preservation Program is essentially very similar in nature to THAP, but it serves Placer County. Their qualifying guidelines are also different, and this program right now is on hold as of the date of this recording. They are reworking some guidelines, so what I'm giving you now, obviously for any of these programs, is not entirely inclusive of everything. This is an overview, but once Placer is back up and running on this, there might be some changes that come out. They also are up to 16% of down payment assistance to you. They require 4% contribution, 4% down payment or closing cost contribution from you. new. So if you were to pair together, which you can do, you can pair these deed restricted programs with the Martis fund to maximize that. So 75,000 from Martis up to 150,000 from these programs, and you can use both of them. If you're needing to bring in 4% for Placer, that also credits towards your 3% for Martis. So if you're combining the two, it's still just 4% of the down payment that you need to bring in. They don't have any income cap. That's what I love about this program, because if your only restriction is that you have to sell it to a local, that is quite easy to do. Like I said, there's a big pool of buyers out there that need this local workforce housing, and not having income caps really widens who you can open this up to. And then this house that you're purchasing with this program has to be within Eastern Placer County. You could actually turn it into a rental down the line, as long as you're renting it to a qualified occupant who meets the local employment criteria. And the deed restrictions on these, they're for a 55-year term that renews at the point of sale. So once it sells, that 55 years starts over again in perpetuity. So that's kind of a general overview, and I didn't put a slide together for Hopkins Village, but Hopkins Village is in Truckee. It's affordable workforce housing. It is a deed restricted project. The purchase price cap right now is at $615,000, so that's the price, and they're great units, and you can use Martis fund in there. So there's money set aside in Martis fund specifically for people who are purchasing in Hopkins Village. You can't use the deed restricted programs in Hopkins Village because Hopkins Village itself is a deed restricted HOA, so you can't have dual deed restrictions. But that is an affordable price that I think is very hard to come by right now, and so to be able to get in at $615 purchase price is amazing toward the units there. I really love it. Taking advantage of these, I think credit is tough, but you can improve your credit fairly easily. I feel like, in my experience, coming up with this, what feels like a massive lift of down payment, is to me one of the biggest hurdles. And these local entities have worked to fill that void for us. And they're not stopping here. They're constantly working on improving this. Even if you may not believe that or may not see it, I see it. I'm on roundtables. I see all of these different entities working together and really trying to find a solution. So there's probably more coming down the line, but I don't know of any other area that offers this much down payment assistance between these. And so I've done a lot. Our team, because I'm part of the team here at Gove Mortgage, we've done a lot of these. We specialize in them. I speak on them all the time. I can mock up what that looks like. What does that payment look like? That's what part of the pre-approval process is. So what we're looking to do once you fill out an application is that we figure out either A, is this going to work now, or B, are we going to have to put on a path to qualify? But part of that is knowing what is your long-term goals, where do you want to be financially, what do you want your payment to look like, how much do you want to put into this, and we work up the numbers. And a good rule of thumb for qualifying, and Dave touched on this when he talked about the meltdown in 2008, is how poorly done these loans were that caused that crisis. We are almost at an opposite effect of that at this point because of how well underwritten these loans are. The guidelines are very tight, and we have to work very hard to get people to fit into these boxes to qualify. They're very, very, very well done loans. So I agree with Dave. I don't see that there's going to be a crash imminent on us. I've seen statistics that it shows that builders would have to be building constantly for 10 years to catch up to the demand. We also have millennials entering the market, which is the largest size of generation entering the market at any point in the history of our country. So you have more buyers than ever coming in and less homes to sell them. And so the demand is there. It's not going away. When I bought, I was terrified. It was a house I absolutely hated. I felt like I was making a mistake all along. And it became pretty evident that when in comparison to peers who chose not to buy at that same time, the gap between our inevitable financial profile, it just keeps widening and widening, because I was willing to be a little uncomfortable for a while for the long term. I was doing a short-term sacrifice for the long-term goal. And this is a long game that we're playing when you're talking real estate. And if you're a first-time buyer, I want you to get out of the mindset that you need to, I think a lot of people enter this like investors do. And you really need to think about the security of having a home and having a fixed payment that is never going to change, because your rent will always change. Your landlord could change. Your security could change at any point. Whereas once you get into these fixed rate loans, you're secure. You know what your payment is going to be. And even if you never gained a cent of equity, which is not ever happened historically, just the 1% pay down of the principal balance each year, you are setting aside 1% equity into the home every year. And so by 5 years, you've paid off 5% of your loan. You now have 5% equity in the property. So it's a natural savings, even if the market never went up. And 2008 was the largest crash in real estate history. And here we are, how many years later? I'll get into the math, but home prices are higher than they've ever been. So when there has been crashes, they do rebound. And so when I'm looking at purchasing for a first-time home buyer or myself, I'm looking at like at least a 10-year. If you have to be there, can I make this work? That's the way that I try to look at it, because over 10 years, you're generally guaranteed to be in a good position as far as equity is concerned. Overall, I really truly believe, and I don't say this just because I'm in the industry, I felt this way before I ever started this, that this is what's going to create real wealth for you and real security for your family, is to enter into the market. So I feel very passionately about that, and I want to help those who want it to get into it. So I'd love to help. And if you have any other questions, feel free. That's our contact info there. That's generally what I had. So back to you, Dave.
So, hey, listen, let's talk about real quick what a rate buy down is, because in the THAP program, that money that's available up to $150,000, depending on the property, you can use that money for, it doesn't have to be for down payment assistance. It can be for other things. Right now, interest rates they seem high to, for you, when you entered the market in 2008. A guy like me is almost 50. These rates aren't high. These rates are not high compared to the first deals I started doing 25 years ago. Let's say we've got ourselves a property, we're getting some money through the THAP program. We want to use some of that money towards a rate buy down so we can have a lower payment for our first couple of years. Ideally, we're going to be looking at lower interest rate environment in a few years. You can refi into that. What does that look like?
Okay, so there's two types of interest rate buy down. So you have a permanent buy down and a temporary buy down. Permanent buy down is rates are at 7.5%. I want 7%. You can do that. There's a cost to do so, and they are called points. Discount points, buying down the rate, these are all interchangeable terms. So the cost to buy down a rate is going to vary day to day, but you could buy down half a point, 1 point, 2 points, and we will price those options out. Permanent buy down buys down the rate for the life of the loan. That generally is not making sense right now, because if you think you're going to refinance in 12 to 24 months, the upfront cost to buy down the rate is probably too high to see the payback. But a temporary buy down is a wonderful tool in this market, because the temporary buy down is a tiered buy down system where for the first year, your rate is bought down, let's say 2%. Rates are at 7.5%. If you do a temporary buy down, you're going to be at 5.5%. And then second year, 6.5%. Third year is when you see 7.5%. And the goal is that you have refinanced before you ever have to see that 7.5%. In a temporary buy down situation, generally the seller is providing that credit. It's a seller credit to the buyer for the temporary buy down. And what we would see do is like you go in at full ask and ask the seller for a 2% credit towards closing costs. We use that 2% to buy down the interest rate. And if you refinance in 6 months, the beauty of the temporary buy down is that seller credit actually follows you to the refinanced loan and gets the principal down. Whereas in a permanent buy down, you lose that credit. Temporary, you still get the benefit even if you refinance.
So that's just one of the several strategies that are available with this grant. And again, it's a grant. This is money that the town of Truckee is going to put in your pocket and essentially can turn that into equity for you. So that's basically a big picture overview of everything that we have available right now. Again, the next steps, if you're interested, are to reach out to Chelsea and start that pre-approval process, and then we can start taking a look at homes that are available. And by the way, there are several available. And by the way, there's a lot of sellers that are willing to work with buyers right now. So hopefully you found this information helpful. We're both available anytime for any questions. You've got our contact info. I'll make sure that you have Chelsea Chelsea's contact info. We'll do a follow-up via email.